If you're a high earner, the biggest investment risk you face isn't picking the wrong stock or missing the next big trend. It's using investment advice that was never designed for your situation in the first place. What works for the average investor often starts to break down once higher tax brackets, larger portfolio balances, and more complex income sources come into play. And yet, most investing advice treats everyone the same. Today, we're going to talk about how high earners should actually think about investing, what matters most, what's often overlooked, and how to make decisions that hold up over time. If you earn a high income, your financial reality is different in a few important ways. First, taxes matter more. A return that looks great before taxes can look very different after federal, state, and sometimes local taxes are applied. Second, scale matters. When portfolios grow larger, normal market swings turn into meaningful dollar changes. Volatility feels different when it affects years of savings instead of months. And third, complexity shows up earlier. Equity compensation, business ownership, or uneven income streams can quietly create concentration risk, sometimes without people realizing it. This is why generic advice like just diversify or stay aggressive while you're young often misses the mark for high earners. Being a high earner isn't just about income. It's about how income interacts with risk, taxes, and opportunity. At higher tax rates, after-tax returns matter more than headline performance. Two portfolios can generate similar pre-tax results and still end up in very different places over time. High earners are also more likely to accumulate concentrated positions. This might come from company stock, a business interest, or a specific industry exposure. Concentration can accelerate wealth, but it also increases downside risk. Understanding these dynamics is foundational. Without it, even well-intentioned investment decisions can produce inconsistent or disappointing results. Markets go through cycles. Interest rates rise and fall. Inflation comes and goes. Volatility shows up when it's least convenient. The mistake many investors make is trying to predict these changes with precision. A more durable approach is to build portfolios that can adapt. For high earners, that means focusing less on timing markets and more on structure, how assets interact with each other, how sensitive the portfolio is to rates or inflation, how much liquidity is available when it's actually needed. This kind of thinking becomes more important, not less, as portfolios grow. Once traditional assets like stocks, bonds, and real estate are in place, many high earners assume the next step is simply taking more risk. That's not always true. Sometimes the opportunity lies in different risk that behaves differently from public markets. This is where private investments, real assets, or alternative strategies may come into the conversation. These strategies can offer diversification benefits, but they also introduce trade-offs: illiquidity, complexity, and greater reliance on manager selection. The key point is this: alternatives don't eliminate risk, they redistribute it. Used thoughtfully, they can improve portfolio resilience. Used carelessly, they can create stress at exactly the wrong time. Professional investors don't just ask, "What should I invest in?" They ask, "How does this investment behave when everything else goes wrong?" Portfolio construction is about balancing expected return, volatility, and correlation. Two investments with similar long-term returns can play very different roles when combined with the rest of a portfolio. One practical concept here is liquidity layering, segmenting assets based on time horizon. Short-term needs stay liquid. Long-term capital can afford to be patient. This reduces the likelihood of selling long-term investments at the worst possible time, which is a common but costly mistake in larger taxable portfolios. For high earners, taxes are one of the most powerful forces shaping long-term results. The difference between nominal returns and after-tax, after-inflation returns, compounds over time. Small structural inefficiencies, high turnover, poor asset placement, or short holding periods can quietly erode wealth. Effective tax-aware investing isn't about avoiding taxes. It's about controlling when and how they're paid, while staying within sound, repeatable principles. Consistency matters more than clever tactics. A few patterns show up again and again: overconfidence in concentrated positions, chasing complexity without understanding trade-offs, ignoring liquidity until it becomes a problem, focusing on returns while overlooking risk and taxes. None of these mistakes come from a lack of intelligence. They usually come from using frameworks that don't match reality. Here's the big takeaway. Successful investing for high earners isn't about finding a perfect investment. It's about building a strategy that accounts for taxes, risk, liquidity, and changing conditions together. Diversification matters, correlation matters, after-tax returns matter most. The strongest portfolios aren't built on predictions or shortcuts. They're built on understanding, discipline, and structure that holds up over time. If you approach investing with that mindset, you're far more likely to make decisions you can stick with, through good markets and bad. Before we wrap up, one last thought. Most high earners don't struggle because they lack information. They struggle because the information they find isn't built for their situation. When investing decisions start to feel confusing or inconsistent, it's usually a sign that the framework, not the effort, needs adjusting. If this video helped you think differently about how investing works at higher income levels, let me know. I'd genuinely like to hear from you. What's one investment question you've struggled to get a clear answer to? Or what's one assumption about investing that you're starting to question? Drop it in the comments. I read them, and they often shape future videos. And if this kind of practical, no-hype discussion is useful, consider subscribing. New videos break down complex financial topics in a way that's actually meant for high earners, not generic advice that misses the mark.